All right, welcome future founders. If you're out there building something that could genuinely change the world, you're going to hit one massive question. How do you actually fund it? Well, in this explainer, we are breaking down the entire playbook for securing venture funding in the US from your very first dollar all the way to an IPO.
Okay, so first things first, let's get one thing straight. Venture capital, or VC, isn't just a loan. It's not just some simple investment. You got to think of it as pure rocket fuel. It is the high-octane accelerant designed to take a really promising idea and launch it into a billion-dollar unicorn at, incredible speed. Yeah, most startups fail, but a VC-backed company, it has way better odds of hitting that massive scale.
And the opportunity here, it's just staggering. In the US alone, venture capitalists deploy around $150 billion every single year. That is a huge pool of capital just waiting for the right ideas and the right teams. So yeah, the fuel is there, you just have to build the rocket ship.
So how do you actually get there? The journey from an idea on a napkin to a public company? Well, it's a steep climb, and it's got some really distinct stages. In this first section, we're going to map out that entire ascent for you. Think of this slide as your roadmap for the entire climb, all in one spot. See how we start with these small checks at the pre-seed stage, and then we progressively move to bigger and bigger rounds, seed, Series A, B, and C, as the company really starts to prove itself. And notice how the investors change too. You go from individuals like friends and family to these major global funds. Let's start at Base Camp. Pre-seed. This whole stage is about the idea. The goal isn't to be profitable, not even close. It's to answer one single question. Is this a problem that's actually worth solving? You're raising smaller amounts of money, from friends, family, and angel investors, to build what's called a minimum viable product, or an MVP, and get it into the hands of your first 100 users. Okay, next up is the seed round. If pre-seed was about validating the problem, seed is all about proving you have the right solution. This is where you hunt for the holy grail of startups, product-market fit. You're aiming to hit that first major milestone, $1 million in annual recurring revenue, or ARR, and build out your core team. This is also where accelerators, like the famous Y Combinator, often play a huge role. All right, now things are getting serious. Series A is the first major institutional round. Your product market fit, it's not a question anymore. It's a fact, and it's backed by hard data. Big-name VCs, think Andreessen Horowitz or Sequoia, they're looking for explosive growth, like 40% month over month is the benchmark. This is when you pour that rocket fuel on the fire and just scale like crazy.
After that, you've got Series B, C, and even beyond. These are the hyper-growth phases. At this point, you're not just scaling, you're expanding into new markets, maybe making acquisitions, and really cementing your spot as a market leader. The focus starts to shift from just pure growth toward building a sustainable, profitable business that's on a clear path to an IPO.
So you've found an investor who wants to give you that rocket fuel. That's fantastic. But it comes with a contract, the term sheet. And understanding this document is absolutely critical. So let's decode the key terms you need to know. The first, and let's be honest, the most talked about term is valuation. Now, the crucial point here is that when a VC talks about valuation, they are almost always referring to the pre-money valuation. This is what your company is considered to be worth before their cash actually hits your bank account. This number, it's the foundation for everything else in the deal. And this slide shows you exactly why that pre-money valuation is so important. Let's just use the example, right? If your company is valued at $20 million pre-money and you take a $5 million investment, the new post-money valuation becomes $25 million. So the investor's $5 million is now 20% of that new total. That 20%, that's the ownership, the equity you've just given up. That is dilution. Now, not all term sheets are created equal, so you really need to watch for red flags. Giving up more than 25% in a single round, that's a warning sign. You gotta watch out for something called multiple liquidation preferences, which can mean investors get paid back several times over before you ever see a dollar. Losing control of your board too early is another classic mistake. And finally, protect your pro rata rights. That's your right to invest in future rounds so you can maintain your ownership stake and not get totally diluted. We've covered the stages and we've covered the terms. Now let's get into the practical, step-by-step game plan for actually going out and raising the capital. This is your fundraising playbook. First off, you've got to set your expectations. Fundraising is a marathon, not a sprint. It's a 6 to 9 month process that is going to consume a ton of your time as a founder. And notice what's step 1.
build traction. You don't start by making a slide deck. You start by building a business that investors actually want to fund. Then you create your materials, get those crucial warm introductions, and begin to negotiate. When it is time to create your pitch deck, please do not reinvent the wheel. Investors see thousands of these things, so they are looking for a familiar, logical story. This 10-slide structure is the industry standard for a reason. It walks an investor right from the huge problem you're solving to your unique solution, your traction, your team, and then finally exactly what you're asking for. You also have to be able to tell your story in 30 seconds flat. In this script right here, it's a powerhouse template for how to do that. Just look how much information is packed in there. It covers what you do, your traction and your growth, your funding ask, and your team's credibility. It's efficient, it's data-driven, and it gets straight to the point. No fluff.
For our final section, let's zoom back in on valuation and talk about the common traps that founders fall into all the time. Getting this right can literally be the difference between success and failure.
So how is valuation actually calculated? Well, for software companies, a super common method is to use a multiple of your annual recurring revenue, your ARR. And as you can see here, that multiple increases as you grow. A seed stage company might get 6 to 10 times its revenue, while a more mature Series B company can command a multiple of 15 to 25 times its ARR. Why? Because it's a much less risky investment at that point.
But, and this is a huge but, those multiples are not static. They are heavily influenced by the public markets, by the overall economy, and as this chart clearly shows, multiples have come way down from the peaks we saw back in 2022. The huge takeaway for founders today is this: you have to be realistic. The valuation you might have gotten 2 years ago is just not the valuation you're likely to get today.
And finally, let's go through the mistakes you absolutely have to avoid. Raising too early before you have any meaningful traction is just a recipe for rejection. But raising too late when you have less than 6 months of cash left in the bank, that puts you in a super weak position. You might be forced to take a bad deal with terrible terms, which can honestly cripple the company for years. Always, always know your numbers and your runway. So what's the ultimate takeaway from all this? At the end of the day, while having a great team and being in a massive market are essential, VCs invest based on proof, and proof is traction. Your numbers, your revenue, your growth, your customer engagement, that's what will ultimately close the deal. They tell the real story. So the final question is for you. Are your numbers ready to tell that story?